Hi everyone, I'm Aura Ogorian with ACap Advisors and Accountants, and welcome to another edition of the ACap Recap, where we go behind the blog to give you quick financial and tax tips. These topics are based on actual questions we get from clients or based on hot topics. Today, we're going to talk about the difference between standardized deduction and itemized deductions. So before we begin, remember to subscribe, like, and share our channel. And if there's a topic that you want us to cover, be sure to include it in the comments section below or send us a message and we will be sure to cover it in a future episode. As you probably already guessed, the standard deduction and itemized deductions are both deductions against your adjusted gross income, which we'll go into next, and I'll explain what that means. But they're both deductions against your taxes, so that means they lower your taxes. The difference is that one's a fixed rate, a fixed amount, and it's based on your filing status. The first one is a standard deduction, it's a fixed amount. The other, which is the itemized deduction, is a variable amount, and it's based on a number of criteria, which we'll also go into. So the itemized deduction is based on your medical expenses, taxes that you've paid, interest that you've paid, and charitable deductions. And you can choose whether or not you want to take the itemized deduction or the standard deduction, but you can't take both. Okay, so let's look at the standard deduction first and see how that's calculated and how that affects your taxable income. Let's look at a sample tax return, a 1040. And in this case, we'll assume you have wages of $160,000. That would be on line 1. And then you have interest income of $100. You have dividends of another $100, and then you have capital gains of $10,000. So your total income, if you sum all those up, is about $170,200. Now this is also your adjustable gross income, assuming you have no other types of income. So we're going to keep it very simple here. If we do the standard deduction, it depends on whether or not you are married filing jointly, married filing separately, or if you're single or head of household. And if you see on the left-hand side, I highlighted here what the different standard deduction rates are. So if you're single or married filing separately, the standard deduction is $12,550. If you're married filing jointly or a qualifying widow, then the standard deduction is $25,100. And in this case, we assumed you're filing married filing jointly. And then if you're head of household, then the standard deduction is $18,800. So let's see how the numbers actually come into play here. So you have your adjustable gross income on line 11. You subtract out your standard deduction of $25,100, and then it brings you to a taxable income of $145,100. So as I said earlier, the standard deduction or the itemized deduction helps to lower your taxable income, which is ultimately what you pay tax on. Now, next, we're going to go over what the itemized deduction is. And as I said earlier, you have the choice of taking the larger of the two, but you can't take both of them. It can either be the standard deduction or the itemized deduction. Obviously, if your itemized deductions are less than the standard deduction, you wouldn't take the itemized, you take the standard deduction. Okay, now let's look at the itemized deduction and what that looks like and the components of the itemized deduction. Itemized deductions are listed on Schedule A, and Schedule A, whatever the sum of that schedule is, flows up to your 1040, which is the first page that we were looking at. So let's start from the top. The first thing is medical and dental expenses. Now let's assume that you had $5,000 of medical expenses throughout the year. To be able to take an itemized deduction, those medical expenses have to be greater than 7.5% of your adjusted gross income. Your adjusted gross income is at $170,200 we calculated earlier. Now, the more deductions you have above the line that bring your the more income you have, the higher your adjusted gross income. That means the higher the barrier for you to be able to meet to qualify for the medical and dental deductions. So in this case, you would calculate 7.5% of the adjusted gross income. It comes out to $12,765. And you'll see on line 4, you're not able to take any medical and dental deductions because that $12,765 is greater than the actual expenses that you had. Now, if your actual expenses were $13,000, then you'd be able to deduct the difference between the $13,000 and this $12,765, but not the greater of the two. The other item that goes on itemized deductions is the taxes you paid. Now, the taxes you paid is a combination of your state and local income taxes, and it's also some of your real estate taxes that you paid. Now, because of the Tax Cuts and Jobs Act, before the Tax Cuts and Jobs Act, you were able to deduct with no limitation your state and local income taxes. But as a result of the Tax Cuts and Jobs Act, that capped the state and local income tax to $10,000 a year on itemized deductions. Now, if you're interested, I did a separate video on the pass-through entity tax that you can look at, which is essentially a way for states, in this case California, to bypass the state and local income limitation of this $10,000. So if you're interested in that, click on the video and watch that. So in this case, we're capped at $10,000. The next section of the itemized deduction is the interest you pay. So this is, for most people, the interest they paid is a mortgage interest on their home. And there are some limitations on mortgage interest, which I will have a separate video on how to calculate that mortgage interest limitation. But let's assume for the time being that $44,540 is the after the limitation. So you have $44,540 of interest that you paid on a home mortgage. And then the next section is gifts to charity. Let's assume you had $25,672 of cash contributions you made to charity. And if we sum up all those, you'll see that the sum comes out to $80,212. If you recall earlier, the standard deduction on a married filings jointly was $25,100. So clearly the itemized deduction is much higher than the standard deduction. And this typically applies when someone owns a home because they're paying so much in mortgage interest, and then they have property taxes, and especially if they're doing charitable deductions, the sum of all those together usually ends up being more than the standard deduction that they're getting. Next, we're going to look to see how this itemized deduction flows on to the tax return again. If we see a side-by-side comparison of the 1040 with the standard deduction and the 1040 with the new itemized deduction, you'll immediately notice that the taxable income is significantly less when you itemize than when you have a standard deduction. So let's take a look. On the right-hand side, we see that we had the $160 of wages, $100 of interest income, dividend income, another $100, capital gains of $10,000, and the adjusted gross income was $170,200, which is also the case when you have the itemized deductions. But the real difference is on the itemized deductions, you have $80,212, but in the previous example, we had standard deduction of $25,100. When you have a standard deduction, your taxable income ends up being $145,100. But if you do an itemized deduction, you'll see that the taxable income drops significantly down to $89,988. For this reason, this is actually the reason why a lot of people buy houses and have charitable deductions. I mean, it's not the main reason why people buy houses, but it's one of the biggest benefits of owning a home is that you have this tax deduction that's available to you through the itemized deductions. Because once you own a home, especially if you have a mortgage on it, you can deduct the interest, the home mortgage interest. You can deduct the property taxes to some extent. You can deduct gifts to charity. And as a result, your itemized deductions end up being much higher than if you just took the standard deduction. For a lot of people, as they get older and they pay off their houses and they have very few deductions, older people tend to start using the standard deduction now because they don't have the mortgage interest. Their tax base is really low because it's based on several years ago. And unless they have a lot of money they paid in charity, they usually just end up doing the standard deduction versus the itemized deduction. Thank you for joining me for another edition of the ACap Recap. I hope you enjoyed this episode. If there's a topic you want us to cover, be sure to include it in the comment section below or send me a message. And remember to subscribe, like, and share our channel. And thank you again.